Well, share markets have been on edge over the past week or so as investors deal with a twist in the AI story. After years of excitement about what artificial intelligence might deliver, markets are now grappling with what it might disrupt. To explain it all, I'm joined by Harry Smith, Portfolio Manager of Global Value for Fisher Funds. Good morning, welcome back.
Hey, Chris.
When it comes to the finance world, it seems like ducks are all the rage, you know, things quacking like a duck, but quacking like a tax and all that sort of thing. But when it comes to the stock market, you're also saying it's kind of like that in terms of looking nice and still on the surface, but actually things are going a bit mad underneath.
Yeah. So if you think about it like the duck cruising along the farm pond, at the moment everything's very calm on top. Global share markets are up around 3% year to date. If you think they should deliver around 7% on any given year, it's a pretty good start to the year. But definitely beneath the surface, as the duck's paddling away, we're certainly seeing a lot of movement and volatility on a sector or company basis.
What is the thing that's actually driving that volatility at the moment?
Yeah, good question. I think there's a few things going on. Firstly, the US, which is 70% of global markets. The US is outperforming what people thought it would. So GDP growth has been very good. Unemployment remains pretty low. Inflation's coming down. We've got fiscal stimulus as we head towards those midterm elections in November in the US, and that's causing a rotation of investors to rotate into more economically sensitive companies. Secondly, I'd say is geopolitics, and here energy is the best performing sector year to date. And if you think energy, it's oil, and then think US-Iran tensions there as well. And then lastly, as you mentioned, AI again for the third year is a predominant theme of the market, and that's certainly creating some gyrations as well beneath the surface.
It's been in the news a lot lately. I read somewhere that 4 large tech companies are investing as much as Sweden's GDP in data centres. That's astronomical.
It's a massive amount, isn't it? Yeah, so around $600 billion, and I think Sweden is the 24th biggest country in the world. But to think about it another way, in today's dollars, these 4 massive tech companies are essentially investing twice as much as what it costs the US to send someone to the moon. And that's just in 1 year into data centres. So the AI trade in itself, we've been through a few iterations since it sort of started on the back of ChatGPT back in November 22. There has been the picks and shovels, which is sort of like the computer chip. So that's largely NVIDIA that brought about the AI. Then there is the data centers. So these are these large tech companies, right? And for data centers, just think massive warehouses that house these chips and have a huge number of cooling systems as well to keep them nice and cool. Because of that, power's also been a theme because it takes a lot of power to turn on these data centers. And then where we're at now is, I want to say, AI productivity, but what's sort of happening is the market's trying to ascertain who are going to be the AI winners, what companies are AI immune, or who are the AI losers, and that's causing a lot of volatility in the market.
Is that even possible to try and ascertain that? Because it is so unpredictable right now, isn't it?
I mean, like, it is causing us a lot of volatility, and there can be like a company can go from being a winner or a sector can go from being a winner to a loser really quickly. Trucking companies have been a recent example of that. But, you know, I think if we just take a step back and think about the long term, what should drive a share price is how much money that company is going to make and how those earnings are going to grow. So a share price will follow earnings growth over the long term. In the short term, a share price can move a lot more around the actual value of that company. And I like to think a bit of a pendulum, right? And that pendulum can swing from fear to greed pretty quickly. So if we go back in history and think, you know, in the depths of COVID, when the share market sold off quite a lot, that was sort of max fear, right, in the market. And then as we came out of COVID and the economy was flush with cash, that sort of went from fear to greed. That's when you had the likes of a Peloton, because we were all going to exercise on our bikes at home in our living room.
That's right.
We had Zoom technology because we were never going to go back into the office. And then I think what's making the market at the moment really interesting is we've sort of got this sort of max fear, well not max, but we've got a lot of fear and a lot of greed going on at the same time. And so if you're considered to be AI immune or an AI winner, there's a decent amount of greed going on in the market. And if you're considered to be an AI loser, there's a lot of fear in the market at the moment. And so I guess my thinking around this is really, there's probably the most famous saying in the market is buy low, sell high. And so it's really just to be cautious of following what's hot and momentum. If we take it back to Peloton and Zoom, when reality didn't meet the narrative, those share prices are now down over 80% from their highs. So just got to be careful following those narratives, right?
So when you're actually talking about volatility, what do you mean? Do you mean share prices moving up, down, or sideways even?
100%, yeah. So share prices, it's just that pendulum, right? The pendulum can swing all over in the short term, can swing a lot. And so investors really just should maybe take a step back. If they have any questions, always reach out to your provider around your KiwiSaver, but really have a long-term focus. Know that if you're going to be invested in the share market, there is going to be this volatility over the short term, but over the long term, with plenty of history, we know that share markets grow and they generally follow the earnings growth of the company.
Harry Smith from Fisher Funds, fascinating chat. Thank you so much for coming in today.
Thank you, Chris.